Soft US services and job surveys support rate cut expectations for later in the year. Australia's headline growth falls in Q1, and South Korea's currency and stock market get a boost from an election which ends months of uncertainty. That's coming up in our 5 Things in 5 Minutes on Thursday, June the 5th. And then in our deep dive interview, ANZ Head of Australian Economics, Adam Boyton, explains why the economy is in better shape than yesterday's growth report indicated.
It's an interesting GDP release for the RBA. You can look at the headline growth number and say 0.2% growth is a bit soft, or alternatively, you can look at that recovery in household incomes.
But first, in 5 and 5 with ANZ. I'm Alex Tarrant, in for Bernard Hickey. US Treasury yields fell this morning on growing expectations the US Fed could make 2 rate cuts later this year. This followed weak survey data for the US economy. ADP jobs growth came in well below expectations at 37,000 in May, indicating a slowdown in private sector hiring. Meanwhile, the ISM Services Index showed activity unexpectedly contracted in the month. ANZ economist Bansi Madhavani says services activity accounts for 78% of US GDP.
Most survey respondents are noting concerns about tariffs and federal spending cuts, especially in the healthcare sector. In that sense, these data have stagflationary flavor to them. However, what we are seeing is that hard data so far are holding up, even though the survey data are soggy. So the Fed will wait for more clarity on the underlying impulse of activity before rushing to cut rates. We have the payroll report coming out later in the week, which will be crucial for the Fed to gauge how the labor market is faring, and that will help in determining the timing of the next rate cut.
At 4 a.m. Sydney-Melbourne time, the S&P 500 was up 0.25% as traders shifted into defensive stock. The 10-year US Treasury yield was down 11 basis points at 4.352%. Gold moved higher, up 0.8% to $3,404 an ounce, while West Texas Intermediate futures were down 1.1% at $62.71 a barrel. The US dollar index was down 0.5%, with the Aussie up 0.65% at 65.02 US cents. The Kiwi was up 0.63% at 60.36 US cents. Number 2. The European Central Bank has a rate call tonight after annual inflation fell below its 2% target yesterday. Bansi says while new PMI data shows some signs of recovery, ongoing tariff headwinds pose a risk to growth.
The macro picture is that of disinflation and subdued growth. That is the reason why we are expecting this 25 basis point rate cut. We also think in terms of their macro projections, the ECB currently have inflation estimate for 2025 at 2.3%, but we think that's high. So we are expecting the ECB will trim its inflation forecasts. Now, following this expected rate cut this week, we see another 25 basis point rate cut in the third quarter.
Number 3. Australia's economy grew 0.2% in the first quarter, in line with ANZ Research's final forecast. But it was below the 0.6% in December, a market expectation for 0.4%, and earlier forecasts. Here's ANZ Head of Australian Economics, Adam Boyton.
Really, what drove the difference between that forecast from last week and the outcome was that public demand was weak and it fell 0.4%. Now it's up 3.8% over the year. We have had about a decade of strong growth in public demand in Australia, so I'm not expecting this single print to mark a new trend. And when we look at some of the detail, I think the economy is probably a little bit stronger than 0.2% GDP growth would usually suggest.
And we'll have more from Adam in today's deep dive. Number 4. South Korea's annual CPI inflation fell slightly to 1.9% in May, just below the central bank's 2% target. ANZ economist Crystal Tan says the moderation was led by food and energy prices.
Core inflation came in at 2.0%, so that's matching expectations. I think the big picture here is that inflation is well contained. It's unlikely to deviate significantly from the 2% target. So it's really going to be about growth and about financial stability concerns that will take priority in the monetary policy decisions. We do continue to see scope for at least one more 25 basis point rate cut this year.
Number 5. Meanwhile, the South Korean won and its stock market rose yesterday following the election of a new president. Crystal says that ended months of political uncertainty that had weighed on the currency and economic activity.
There is scope for foreign inflows to return in a more meaningful way. So that's, again, another potential support for the currency. So I guess in terms of what we're watching next is what's going to happen with the US trade negotiations. So if we do get positive news on the trade talks front, then that could add yet another tailwind to the currency.
Crystal Tan there. Now in our deep dive interview, ANZ Head of Australian Economics, Adam Boyton, explains why the Australian economy is in better shape than yesterday's first quarter GDP suggests, and why he continues to expect the next RBA rate cut will be in August versus July.
Private demand continued to expand. It's coming off a low base, but we have had now 2 quarters of okay. You wouldn't call it strong, but you'd sort of say it's okay growth in private demand, a sort of an early recovery, if you will. But I think if I step back a little further, looking at the household income story does suggest that household incomes, after having been quite constrained 18 months ago or to 2 years ago on the back of higher inflation and interest rate increases, we're now getting quite robust growth in household incomes. What that then suggests to me is that a lot of the softness we've seen in consumer spending reflects the household sector being cautious rather than constrained. And at some point, that household sector caution, particularly with the Reserve Bank cutting interest rates, should see household spending pick up.
How will the RBA be looking at these figures, do you think? And how does this fit in with that story of whether there's going to be a July rate cut or holding off to August?
It's an interesting GDP release for the RBA. You can look at the headline growth number and say 0.2% growth is a bit soft, or alternatively, you can look at that sort of recovery in household incomes that suggests the underlying income dynamic in the economy is okay, particularly as far as the household sector is concerned. They may tend to cancel each other out, and then I think the Reserve Bank will also take a look at what unit labour costs are doing. So this is the combination of wages growth and productivity. The reason why the Reserve Bank might look at those is they do tend to be reasonably correlated with inflation. So unit labour costs in this release running at 5% year on year. So that's about double the pace of inflation, and that may temper, I guess, some of the confidence the Reserve Bank has that inflation has not just come back to the target band, but is going to stay there.
And what does activity look like for the economy over the rest of the year, do you think? Will that public demand pick up?
We've had a decade of public demand growth averaging about 5% year on year, which means in any given quarter it's growing at about 1% or a touch more. So if I look at that minus 0.4 that we got in the first quarter of this year, that seems a little at odds with this long-standing trend. So I'm not expecting that we're going to see an environment of weak public demand. I expect next quarter we'll get a bounce back. There's also some technical things in the way the Bureau of Statistics account for electricity subsidies that means when these things are introduced, they boost public demand and depress private demand, and then when they're unwound, they do the reverse. So some of the increase in household consumption reflects the mechanical application of the way the ABS accounts for these things. That also means some of the softness in government consumption we saw in this quarter also reflects the mechanical way the Bureau of Statistics account for these things. But I don't think this soft public spending number in this set of GDP data marks a new trend at all.
Adam Boyton there. I'm Alex Tarrant in for Bernard Hickey. That was 5 and 5 with ANZ for Thursday, June the 5th. Catch you tomorrow with a review of the ECB's rate decision.
This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.